How do capital gains affect your farmland sale taxes? When you sell farmland, the profit you make from the sale can impact your taxes through what's called capital gains taxes. This profit is the difference between the sale price and your basis in the land. Your basis is usually what you paid for the land plus any improvements you made, like building fences or planting trees. If you inherited the farmland, your basis is often the fair market value at the time you inherited it, which is called a stepped-up basis. Capital gains are divided into two types, short-term and long-term. Short-term gains happen if you own the land for less than 1 year before selling. These are taxed at your regular income tax rates, which can be higher. But most farmland sales are long-term because farmers or investors usually hold land for more than a year. Long-term gains are taxed at lower rates, typically from 0 to 20%, depending on your total taxable income. Federal tax brackets for long-term capital gains on farmland are about 0% if your income is below certain thresholds, 15% for moderate incomes, and 20% for higher incomes. If your income exceeds $150,000 for married filing jointly or $199,000 for single filers, you might also pay an additional 3.8% tax called the net investment income tax. State taxes can also apply and vary widely depending on where your farmland is located. To figure out your capital gain, you subtract your basis from the net sale proceeds, which is the sale price minus any selling costs like commissions or closing fees. The difference is your realized capital gain, and that is what gets taxed. There are ways to manage or reduce these taxes. You can use installment sales, which spread the payments over several years, lowering your annual tax burden. If you inherited the land, your stepped-up basis can significantly cut your capital gains if you sell soon after inheriting. Also, if part of your farmland is used as a personal residence, you might qualify for capital gains exclusions on that portion. Knowing these rules helps farmland owners plan their sales better. Proper valuation, keeping good records of your basis, and timing your sale can make a big difference in how much tax you owe. By understanding how capital gains work, you can make smarter decisions to keep more of your profit from farmland investments.